good afternoon everyone. I hope you're all keeping well. Thank you so much for joining us this afternoon. Today I'm joined by Phil, our CFO, and James, our Regulation and Compliance Director. I'm hoping that you've had a chance to see the video that we put out this morning, and we're really looking forward to taking some of your questions. So without further ado, I'll hand over to Chris and look forward to taking your questions. Chris, over to you.
Absolutely. Thank you very much, Lou. Good afternoon, everybody. And I think, I apologise, everyone. I didn't see whose hand went up first. So we'll go to you, Pav. If you'd like to ask your question, please go ahead.
Thanks, Chris, and thank you, team, for the video this morning and for taking my questions. I've got three, please, if I may. So the first one is looking at the funding for your plan now that you've got the DD and your submissions. When you submitted the plan in October, you were talking about an average of 65% gearing over AMP8, and that assumed incremental funding coming from cash and senior debt. Can you provide an update on that position, please, and whether you think you need new equity now? My second question is on the quality of your plan, and clearly you didn't get outstanding status. Based on your engagement with the regulator and having gone through the details, is there anything you think you could have done differently to get outstanding, or do you still stand by your plan that you submitted as being the best in terms of balancing for all stakeholders? And then my final question is on long-term RCV growth for the sector. I thought the chart you provided in the presentation was really useful. And my question for you specifically is, can you talk about how many of the schemes in your AMP8 plan are multi-AMP, and if you can give us an idea of how much of the long-term RCV growth for UU is underpinned by those schemes that are starting in AMP8? Those are my questions. Thank you.
Great, thanks, Pav. Look, three questions. I'll probably divide them up. I'll start first with the quality of the plan, in terms of the quality of the plan that we submitted. It was, we were really pleased to see that our plan was assessed as high quality. In fact, I think we've passed more of the quality test than anybody else. And we put forward a highly ambitious plan compared with where we are today. I think what is clear is that Ofwat has reviewed ambition on a more absolute level and not a relative level in relation to the infrastructure we have here in the Northwest, the amount of rainfall, etc. So when you look at the stretch that we put forward, we absolutely stand by that and the quality of the plan that we put forward. But it's that absolute as opposed to relative level where that difference has been. I'll hand over to Phil to just pick up on the point around our equity and gearing specifically, and then I'll pick up the point on RCV growth. Phil?
Okay. Thanks, Pav, and good afternoon. So firstly, I guess worth remembering we start from a very strong position in terms of our balance sheet, in terms of our gearing position at 59% at the moment. That gives a lot of flexibility. As you noted, the DD response, I guess, is very similar to our actual submission. It's slightly lower TOTEX, slightly higher sort of cost of capital. So that's a slightly better position than the underlying plan that we put in back in October. So that's favourable. I suppose ultimately we need to understand how Ofwat's going to react to that and the roll forward to the final determination, and we'll be looking at that in the round, looking at TOTEX, risk and return balance that we get in terms of the overall FD. So I think really we're sort of in a very similar position, slightly improved position to where we were with the original plan going in October.
And Pav, just to pick up on your third question about RCV growth, and I think that chart is actually quite helpful in terms of seeing what's ahead, because what actually continues, if you like, to build and compound is the legislation. And we talked about there being three buckets, if you like, in the presentation this morning. Essentially, the new environmental enhancement, of which has drivers that come in at different date points as we look forward. Upgrading the existing infrastructure that we have as a result of age and the need for improved resilience. And thirdly, how we continue to adapt to climate change. So all of those things continue to build. In relation to the specific question, is there anything in AMP9 that is a sort of carry forward from AMP8? There's about £400 million in AMP9 of spend of projects that get started at the back end, if you like, of AMP8, or have sort of additional drivers that come in AMP9. And then there is the additionality of the new schemes and the new requirement in AMP9 as we go forward. So, a significant amount of TOTEX growth that builds AMP on AMP as those drivers come in, but there is some carry forward based on some specifically large schemes that we have in the plan too.
Thanks, guys.
Thanks, Pav.
Terrific. Thank you, Pav. Next, I think we'll go to James Brand. Welcome back, James. Go ahead, mate.
Hello, can you hear me?
We can, James.
Hello again. So I'll have three. It's only my third day back, so hopefully this ground has not been covered already in other calls. But I've got three questions. First is on the allowed return, and it seems like obviously the allowed cost of equity moved quite meaningfully in the right direction, but the cost of debt, particularly the allowance for new debt, still seems quite stingy, I would say, although I understand there's some idea that it might be reviewed again. So I was just wondering what you felt about the cost of debt allowances and what you think the cost of raising debt is at the moment, because it seems like for some companies it's very high. So that's kind of like the first question, I guess. Secondly, on the cost allowances, you got all your kind of base cost allowances, but the enhancement capex was scaled back quite significantly. So I was wondering whether you could maybe just talk us through what the differences are between what you received and what you proposed, and how much of that was scope and not doing as much, and how much of it was an efficiency challenge. And then thirdly, there was this Supreme Court ruling around the ability of landowners to sue for sewage damages, and I guess that will probably take some time to digest, but I was wondering whether you had any early thoughts on what that means. Thank you very much.
Perfect. Thanks, James, and lovely to see you back. So in terms of those three questions, why don't Phil, you cover allowed returns, James cost allowance, and I can pick up on Supreme Court. So Phil. Okay.
Hi, James. Allowed returns, I think your question was focusing in on the debt component in particular. And I think you were questioning that it looked on the low side. So I guess Ofwat's cost of debt position ran through to March 24 when they sort of drew the numbers up. That means that they haven't yet taken into account all the APR reporting for all the water companies for FY24. So obviously the embedded cost of debt will need to be updated to reflect all of that. So we might see the embedded component creep up from where it is at the moment. Clearly, on the new cost of debt, I think Ofwat used a rate of 3.36% for the new cost of debt. Add sort of 2% to that for CPI inflation, and you're at sort of 5.36. Our Frontier Economics sort of position that we put back into Ofwat showed 2.99 as the cost of debt, with a 3.64 new cost of debt component. So effectively about 30 basis points higher than the Ofwat piece. But even with that sort of new cost of debt in our Frontier Economics report at 3.64, you're only getting to about 5.64 as an overall cost of debt allowance for new cost of debt. And I suppose if you look at some proof points in terms of issuance in the sector, and if we just focus in on probably three of the highest quality companies in terms of debt issuance, you had UU issuing debt back in May 24. We issued at a coupon of 5.75%. We had Severn Trent issuing in July 24 at a coupon of 5.875%. And we had Southwest issuing in July 24 at 6.375%. So you can see there sort of three bond issues, all of those above effectively the sort of cost of debt allowance. I think that sort of says there's quite a lot more to sort of look at in terms of catching up with the cost of debt, and in particular you'll see representations from various companies on the cost of debt adjustment mechanism, and we're advocating that rather than using the ABBB general bond index, we should be focused on the utility bond index, and there's about 40 or 50 basis points delta there. I think other companies are arguing that there should be a sort of 40 or 50 basis point adjustment. So that is all in the representations that have gone back into Ofwat.
Great, thanks, Phil. James.
Yeah, so you're right that in terms of BotX, we were very much judged to be efficient, and that was passed through. In terms of the enhancement spend, there was around £2.6 billion of challenge. We've provided evidence back on around 2.1 billion of that, and I think it's fairly clear for anyone to see that an awful lot of the difference was on overflows and this sort of estimates on that. So we've gone back with a very large suite of evidence on that. Firstly, to sort of demonstrate how we have gone about estimating those costs in terms of the overflows. We've got specific bottom-up estimates for 449 sites, so we know what those costs are, and we've provided that in spades, I think, in terms of our representation. We've also explained to Ofwat where they may be missing some of those costs when it comes to their modelling approach and additional factors that should be added into the models. I think in terms of scope versus efficiency, I think there is some scope in terms of the overall approach that we're taking, but a lot of it is really around re-optioneering and looking at slightly different solutions. So I think if we're looking at the Frontier company on overflows costs, for example, it's pretty clear that that company will be looking at some cheaper solutions, which may be cheaper in this AMP or over a couple of AMPs, but probably not as long in terms of lifespan, possibly not necessarily the lowest whole life cost approach, but they would keep costs down in the shorter term. So I think what we've done is we've looked at a number of sites and put some sort of challenges in there and made some changes there. But as we go through the programme, we're pretty confident that we'll be able to identify some further efficiencies and some savings by looking at these sort of alternative solutions as we go. So hopefully that gives you a picture of where we are in terms of the enhancement representation.
Great, thanks, James. And you asked a question about the Supreme Court and the Manchester Ship Canal. I think it's still early days, James, in terms of post the Supreme Court ruling. We're looking at what the impacts of that are. We're also working on understanding where there may be other risks associated with riparian ownership across the more broad sort of position more broadly. But essentially there will continue to be a number of conversations in relation to the Ship Canal as we move forward. Thanks, James.
Okay, terrific. Thank you very much. I think, Ahmed, we're going to you next, although you seem to have dropped off my list at least. We'll go to Mr. Freshney in the meantime.
Hey, hello, thank you. I have two questions for Phil, sorry, and only one for Lou. But Phil, there's this horrible circularity in that the tougher the review, the more credit costs go up, and Ofwat have to basically come back and give higher returns. And you spoke about potentially giving, moving to a different index. I mean, how do you see that playing out, that there's a tough review that causes debt costs to blow out, making it even tougher? And further to that, I think when we spoke nearly a year ago now, when you filed your business plan, you spoke about potential for using holding company debt. I think given what Ofwat's proposing to do at 70% net debt to RAB, you want to stay well away from 70. You want a lot of buffer, right? And holding company debt is pretty risky, right? So would you still be prepared to run holding company debt? And how far below the 70% do you want to be? And my question for you, Lou, is I understand there's an interview as part of the process that you'll be attending with Ofwat, or a representation. What is the major punchline that you'll be resonating with Mr. Cuscio and Mr. Black and the team? What is the major punchline that you'll be getting across in that interview?
Okay, thanks, Mark. Phil, do you want to pick those up?
Okay, well, thanks, Mark, and nice to see you. I think your first question on the circularity in terms of the credit piece, I think is a very, very pertinent point. I think most people will have seen also the Moody's commentary, which I think reinforces that same issue, really, in the context of, calling out the the deterioration in the predictability of the cash flows from the review process, and effectively the tightening of credit metrics on the back of that as a consequence. So all of that is quite circular. I think there's been a lot of representation from many stakeholders back into Ofwat on those points. And so I guess we'll need to see how that plays through. I've got no crystal ball, so I can't predict, but I think there is quite a lot of compelling evidence. And as I was just talking in the earlier question with James, you can see the cost of debt that the three higher quality utilities in the sector is above the cost of debt allowance that Ofwat is predicting for new cost of debt. So all of that, I think, plays into proof points that are being made in the representation process. In the context of sort of the overall gearing position, we talked at the time of the October plan how we were averaging circa 65%. Effectively, the TOTEX programme is a little bit lower. The cost of capital is a better cost of capital position. So, we're going to have to see how all that plays through. And, starting from a position of 59%, 70% is still quite a way away for us.
Great, thanks, James. And in relation to the, what are the key punches or conversations that we're going to have as we go forward? I think you'll hopefully have seen our 2-page representation that we also published in relation to our representation meeting with Ofwat. And there are actually 5 key things. Some of them are interlinked, but I just think it's important that we understand the context of the 5. So the first is around TOTEX and enhancement spend, and specifically CSOs. So the conversation we were just having in relation to the evidence that we've put forward. The second is around the gated mechanism. We are supporters of the gated mechanism. We think they can work well, but there's some projects in the gated mechanism that are now defined. The scope is being clearly signed off with the Environment Agency on our deliverable, and we think that they can be moved. The ODI package in the round and what that's looking like, and in particularly the need for focus around specific measures, targets and caps and collars. The fourth is just around returns more broadly, and that's where you'd expect us to pick up on the specifics, particularly around WACC and some of the more sort of input measures around business rates and things like that. And the fifth being around bio and uncertainty mechanisms around farming rules for water. So the 5 things that we will be talking to Ofwat about are the 5 things that we've put in our 2-page representation. They are the key things. There's lots of things, as you'd imagine. There's 2,500 pages we've gone back with. But what we're trying to do is be clear and represent on the things that we think are going to make the biggest difference. Thanks, Mark.
Okay, thank you very much, Mark. Excellent. Ahmed, I see you're back.
Yes, hi. Thank you for taking my questions. I just a couple of ones. Firstly, just to help me sort of reconcile your the RCV growth chart that you're showing with the business, the one that you showed at the time of the business plans you published a year ago. Could you tell us a little bit, right? It seems to me that the 4 to 5% that you're showing is excluding the gated mechanism TOTEX, so it's about with 10 to 11 billion of TOTEX spend. Could you tell us what would be the RCV growth rate that you would project if you were to include, let's say, sort of the gated schemes that you're showing on slide 4, and then also the enhancement spend of 2.1 billion, if I've understood this correctly. And then maybe Phil, to you, could you just talk a little bit about how you see the gearing and your comfort with the balance sheet of the company under each of these TOTEX scenarios? Thank you.
Great, thanks, Ahmed. So I'll pick up the first question and then I'll hand over to Phil from an enhancement perspective. So we've talked in the presentation about 4 to 5% of the RCV being already secured based on what we've seen at the DD, and that moves to sort of 5-6% with the gated mechanism. In relation to your additional question on the additional 2 billion that we have made representation on, that would see a movement just over 8%. So that's how those things sort of sort of square off, if you like, in terms of the movement that we expect to see. So 4 to 5 already secured, 5 to 6 with the gated mechanism, and as a result of that, additional 2 billion, sort of circa 8 to 9. So that's where we are in relation to gearing more broadly, Phil.
Yeah, so hi Ahmed. I guess just sort of recapping a little bit, sort of, starting from a very strong position in terms of our balance sheet strength and position today. In terms of the DD itself, clearly there was only 10 billion of TOTEX in that DD, so that has a very minimal impact in the context of the overall position for the company. If you look at our DD response, there, our TOTEX position, including everything that Lou's just talked about there, our TOTEX position was slightly less than the overall submission, and effectively the cost of capital is higher than where we were back in the submission. So that's a slight improvement from the business plan submission in October, so a slightly better place. And as for sort of what that all means, I guess, ultimately we're going to need to understand the TOTEX position that's allowed the risks and return package that Ofwat comes forward with. But actually we're in a slightly better position today than the October plan, effectively.
Thanks, Ahmed.
Okay, thank you very much, Ahmed. John Campbell, you're next up.
Hi everyone. Yeah, thank you. I've got 4 questions if I can. So I'm looking at your representations, and you say in your risk and return, you say that Ofwat should allow 5% equity issuance costs at the final determination. And my question is sort of how should we interpret your request for equity issuance costs from Ofwat? Because I didn't spot these, for example, when I glanced at Severn Trent and Pennon's representation. So how should we think about that? The second one, I think, relates to outcome delivery incentives. So as things stand, you essentially seem to be at risk of losing quite a lot of money on internal sewer flooding. Severn Trent have their own. They've got the carbon gas sort of ODI as well. Do you think Ofwat will essentially remedy this ODI mechanism by the final determination? And what would you do if they don't remedy it by the final? The next one I had, do you think Ofwat is amenable to raising the allowed rate of RCV runoff to essentially better balance bill growth in AMP8 versus future AMPs? And the final question I had relates to Ofwat's wastewater investigation. Do you have any updates on it, and how should we read into the fact that you were added on the 16th of July 2024 when the investigation started in November 2021? Thank you.
Okay, I think I've captured those all, John, while you were talking. So I think there were sort of 4 things I captured there. The first was about the 5% equity issuance, ODIs, RCV runoff, and then the Ofwat wastewater investigation. So Phil, if you want to pick up on equity issuance, and then James on ODIs and RCV runoff, and then I'll pick up on the investigation.
Yeah, thanks, Lou. And hi, John. On the sort of equity issuance, there's a modelling assumption in the plan around cost of issuance, and we've represented that we think 5% is the right allowance to be putting into there, and I guess that position is something that is whether you need to or don't need to raise equity. It's sort of they will work through the notional company position and should be allowing the right returns based on that notional company position effectively. So that's why the representation is saying that we need the 5% issuance cost allowed.
Okay.
On performance commitments and internal sewer flooding, you mentioned internal sewer flooding in particular, and you're right, we have put in a very substantial representation on that, which you may well have picked up. Obviously, we're calling out, we think that there are a lot of issues around Ofwat's approach here, and that it doesn't take into account the sort of circumstances in which each company is operating. The risk, I think, with the approach that they're set on at the moment is that some companies end up with a very straightforward target, which is easy to meet, and therefore earn easy rewards for their performance, which isn't particularly stretching. That means that customers are paying those companies too much, and other companies, I think, are in a much more challenging position where they would effectively end up with pretty much a guaranteed penalty. So we've put forward a very substantial representation on that, which you'll have seen. I think you're right to note as well that most companies have put in representations on particular ODIs. where the approach doesn't appear right. I think overall, in general, companies are representing that the ODIs are skewed to the downside. So I suspect that's going to be an area where there's a lot more discussion. And in fact, Ofwat's already started a workshop which is set, I think, for a couple of weeks' time to start talking about the overall direction of that package. As to will Ofwat remedy these, well, I think Ofwat's given you the best answer on that when they held a call, I think, a couple of weeks ago and said that they had been surprised with some of the feedback and that they were going to look at that, take it into account and come back with some potential revisions. As I say, the workshop in a couple of weeks is probably the start of that process, and we'll get more of that over the coming months. So I guess in answer to the final question about what will we do if they don't, I think we need to see what the outcome of that process is, and I'm pretty optimistic and pretty positive about the fact that Ofwat will look at it and make some adjustments as it's suggested it will.
And RCV runoff?
Yeah,
Do you want to pick that one up, Phil?
Yeah, I'll pick up the RCV runoff question, John. So I guess a few points to make, really. Firstly, cash flow is really important to the companies. The challenge in terms of the forecast plans is making sure we've got enough cash flow coming through the income statement. So I think it is an important point. But I think the second thing to balance against that is, clearly this is about the overall level of shareholder returns that are necessary as well. And it's important not to conflate cash flow with shareholder returns. So we need to make sure we get the right returns package that makes the industry attractive for people to want to invest in terms of equity. And cash flow is a sort of secondary consideration in that respect. And thirdly, clearly the rating agencies and Moody's are very, very explicit about this. They strip out and adjust any acceleration of RCV runoff and pay-as-you-go above natural levels, because what you're doing is you're taking money from tomorrow to pay for today. And so they sort of make that sort of adjustment in terms of how they assess the industry. So it's not a panacea to solve problems, but at the margins it might have some benefits.
John, in relation to your question about the Ofwat wastewater investigation, I think it's probably two things. First of all, the EA investigation first is ongoing, and we continue to comply with that fully. And the EA opened an investigation into everybody across the sector. I think the EA is sort of targeting a mid-2025 date for conclusion of their investigation. But from an Ofwat perspective, they extended their investigation, as you say, in July to include us, Severn Trent and Welsh Water. So previously it had been the other WASCs in the sector. It's obviously a live investigation, so it's a bit difficult to go into detailed comment. But other than to say we are cooperating fully, as you'd expect us to do. I think from a timing perspective, Ofwat has indicated that the remaining 4 companies that they've added in, obviously, will be, it's not going to sort of start again, if you like, in terms of the investigations they've got for the 6. And we're hopeful that's going to be resolved quickly and efficiently as we move through the process. So yeah, it's all companies in the same way that the EA is all companies too.
Okay, thank you.
Terrific. Martin Young, welcome.
Thank you. Can I just pick up on the ODI issue? As James has said, certainly if you look across all the companies, whether they be water and sewage or water only, presentations pointed to a significantly negative skew versus what Ofwat had originally suggested. Most companies have made representations to try and address that skew. Give or take, and please correct me if I'm wrong, I think you are coming out with plus 2.3% at P90, minus 2.7% at P10. I think Wessex are somewhat in the same ballpark. Other people, even when you include the measures of customer experience, are seemingly coming out with tighter ranges. If Ofwat were to move, what do you feel is the right type of plus or minus range for an appropriately calibrated set of ODIs that work for investors, that work for companies, and what most importantly, work for consumers. Thanks.
Hi, Martin. Nice to see you. So I suppose, the first thing I'd say is, I think before we sort of get into the details of this package, UU's got very strong historic performance. We support the move to more comparability, but the right returns should reflect the key areas of importance that both customers and stakeholders have said are important to them. But I think as you've picked up, both in terms of the representations and also the conversations that Ofwat have had more broadly with the market, is there is a view that they are skewed more to the downside in relation to into how they're working, and that there's a real need for better calibration of performance targets and incentive rates and the applicability of sort of caps and collars. And I think Ofwat have been very clear that they intend to look at the measures more sort of specifically in terms of how they're working. But from an FD perspective, it's always going to be a holistic assessment. So when we've got to look at the areas of strength, the areas of challenge, there are some things in there where United Utilities perform well. As you know, we've represented hard in terms of sewer flooding as a result of our infrastructure and rainfall, etc. But I think what is quite interesting is there is a high level of consistency right across the sector in relation to the feedback on ODIs, although there is a different view in terms of those return rates. I think though what is positive is that Ofwat have said they are absolutely looking at it, and I think that's been consistent both in their feedback to companies, but also to the market too. James, anything else you'd add?
Yeah, so Martin, I think we've gone back with some proposed changes to the ODI package. I mean, we've looked at what Ofwat's come up with. Some of it is possibly slightly better than we proposed. Some of it we've accepted as being not in line with what we proposed, but acceptable. And then we've made a number of representations on some ODIs where we think a more significant change is needed, whether that's either on the target or the incentive rate, or sometimes just the application of a cap or collar, in order to reduce the volatility. Where we end up as a result of that is broadly the same kind of range that we proposed in our original business plan. So, on the ODIs overall, I think we would expect something in the range of plus or minus 2 to 3%, something in that order, and that seems to be, about the right level for ODI variability as a part of the whole package. So, I suppose what we've tried to do is to adopt the draft determination where it looks reasonable. I think some of the more outlandish results are what basically throws the results out of balance, and so what we've done there is basically suggested some combination of change of the target incentive rate or the cap or collar as appropriate. And as I say, I think we're very positive that Ofwat's looked at that, understood the concerns, and is taking a closer look at what people are saying about it.
Okay, thanks. And given the sort of the strength of the pushback from the industry to Ofwat, would suggest that it's quite a lot to be done. Cognizant of the fact that DDs were a little bit later than they should have been, given the general election, there is that provision to push the FDs back into January. Has that risk of slippage of the FD increased because of the strength of feedback? What, in your opinion?
I mean, I would just say that I think everyone's got their sleeves rolled up. I think everyone would like to see the decisions made before Christmas and get the FD decisions out on December 19th, and that's what we're planning for, and that's what we're working towards. I think the fact that Ofwat's already put in place a workshop on ODIs, for example, suggests that they are moving quick and committed to doing what we can. So I think at the moment our base case, our sort of main plan, our main expectation is that these FDs will be out before Christmas. But I think it's not unhelpful that there is that scope for a slight extension if necessary. But I think everyone's very committed to getting this done on time if we can.
Okay, thank you very much all.
Great, thanks Martin.
Thanks, Martin.
Thank you, Martin. AJ, welcome. Would you like to go next?
Fantastic. Thanks for taking my question. Mine's just I know you're not going to give me the answer here, so I just want a more understanding of philosophy more than anything else. Is I look in this model and I go, okay, the dividend yield that you've assumed here is 2% in the submission, and you can model the regulated equity going forward by 2030, and you multiply one by the other, and you go, okay, that dividend that you get there is lower than your current dividend policy if you were to extend it out to 2030 linked with inflation. And I'm just wondering, you've got this other slide that has a fantastic amount of growth that goes from starting from this review all the way out to 2050. So there's this sort of mismatch in mindset, right? That the water sector, and particularly yourselves, are going from a period of time where there isn't huge amounts of RAB growth to huge amounts of RAB growth. Going from a situation of being more income, I guess, in some respects, or lower growth, higher income, to possibly higher investment. And usually there's a balancing act with that. Is the aim here to grow the RAB into that dividend and effectively grow dividends in line with inflation and eventually catch up over time? Or is there a recognition here, or at least a thought process, that there's a step change, and therefore the way that you look at this is completely different, and therefore all options are on the table? Anything that you can give into that thought process would be really helpful, because at the moment when I look at all of this, I can just see, well, if you keep your current dividends running, gearing just moves up, and as Mark was highlighting, 70% seems to be a threshold that's not easy. So yeah, could you somehow put those cocktail of thoughts together and maybe give us some of your own views? It would be really helpful.
Okay, thanks, AJ. I mean, look, I think what I'd say is that RAB growth comes from those three areas that I talked about previously. So it comes as a result of the changes in terms of environmental legislation, the need to upgrade the existing asset infrastructure, and as we respond to climate change more broadly. And as you say, within that context, there is the need for growth and looking at the dividend more broadly. We're obviously going to wait until we get the FD, until we make or give any further update on our dividend policy for the next AMP, because it's really important that we look at that in the round. And our proposal would be that we update on that early next year as a result of understanding all of those various different levers that will play through in relation to the FD when it arrives. Phil, anything else you'd like to add to that?
Yeah, just to build on it in one respect, you mentioned the 2%. It's probably important to recognise that the table submissions were all about the notional company rather than the actual company. And so clearly the actual company and our representations on the actual company are different.
I was just thinking, if you put that together, right, if you choose to pay a dividend that's higher than that, then in essence the leverage numbers that we see in these models would be higher, right? And I know that you have, I think it's about 600 million or so at cash at the holding level, which could be also used to act as a buffer. But so I can understand how that fits for maybe the next 5 years, but the point here is the investment's not going to slow down, and therefore it's okay for now, but all it'll do is raise the same question in 5 years' time. Yeah. And at the moment, I don't really get it unless you're going to outperform by a lot. Yeah. And that would be nice if you could tell me that today.
Yeah. Well, I think we'd say, AJ, we need to wait to see what the final package is before we make any of those proclamations. But look, what I'd say to you is this, and it's a question we got asked at the point that we put the plan in, which is, well, actually, if you look out to AMP9 and AMP10, aren't you going to need equity at that point? And the answer is, well, hold on a minute. We'll deal with AMP9 and AMP10 once we're through as we've started and we're through AMP8, because what we're trying to do is look at the plan that we have on the table now, the returns that we have on the table, and actually how we fund that and how we fund that successfully. So I think it feels like a politician's answer, and you were probably right when you said you're not going to probably answer this, and I feel I have answered it like a politician. But we're going to have to look at what this looks like in the round when the FD arrives, and look at that position, and then consider what we do in AMP9 and AMP10 at the point that clarity is also clear. So I think it's about looking at it from the context of the water sector is moving from a position actually, or a growth position that it hasn't been in the past, and as a result of that, we will need to look at that in the round when we get the final package.
it just makes that return that they eventually give you so much more important, right? If funding is equity is going to be needed in future investment periods. But thanks.
Yeah,
very helpful.
And obviously you can see that we've represented that on that quite heavily in our submission that we've returned.
Okay.
Thanks,
you.
AJ.
Thank you very much, AJ. Mark, back to you.
Hey Lou, a question on current trading. It was about 2.5 years ago you really started ramping up additional spend, partially to deal with storm overflows and the related issues. And it, in CapEx terms, that wasn't too long ago. What are you seeing in terms of the fruits of that, and in terms of pollution incidents and the suite of indicators? I guess the ones on the EA report that comes out every July or so. What are you seeing, and are you seeing a tangible improvement? Because as I see it, this industry is not going to move off the front pages until there's an undeniable an improvement, right?
Yeah, so I suppose two things. Obviously, in relation to our pollution performance, we've been one of the leading companies in the sector. We're the only company that's been green for 14 consecutive years on serious pollutions. Those things remain consistent in relation to where we are currently. I think in relation to CSO spills, I think some of this, Mark, it is going to take time to get that infrastructure in the ground. We have been putting in some accelerated solutions. Some of those you'll find on our YouTube channel, and actually they are showing real returns very, very quickly. And so where we can install those solutions, that's exactly what we have been doing, and we continue to do so, versus some of the bigger solutions that are particularly in this plan, where they're actually interventions that we've got to make into the network, and that network may be, under motorways, under roads and everywhere else. So, where we can put interim solutions in place, then that's absolutely what we will do. But the stuff that we're talking about here is the stuff that is heavy construction and has big lead times. So a mix of two as we move forward.
Okay, thank you very much for that. Ahmed, I think you've got a follow-up as well.
Yeah, a follow-up on ODI. So it seems to me for the challenge, or sort of, let's say, the downside rate specifically comes from three specific ODIs, so internal sewer flooding, leakage, and storm overflows. Is that sort of fair observation? And then my second question is, if you could just give us some more granularity on what improvements specifically you are asking, or you're sort of hoping to achieve by FD on these specific ODIs.
So if you haven't, and you probably haven't, because it's a long read, but it's a great read, is that we've made a significant representation on internal sewer flooding, and I'd encourage you, if you perhaps not look at anything, to have a good look at that, because it's a really strong document that talks about the fact that we have very different infrastructure here in the northwest, high level of it being combined, and the levels of rainfall, etc. So it's very much evidence-led. And the fact that we put forward one of the most aggressive improvements in terms of sewer flooding reduction. So although Ofwat may have looked at it on an absolute basis, when you look at the level of improvement, it is significant. So that's a very evidence-based sort of representation that we've put back. In relation to storm overflows, we do have a different trajectory on storm overflows compared to the rest of the sector, where that starts at a higher number, recognising again some of the sort of differences in terms of our infrastructure and rainfall rates. So I'd really have a look at the representation that we've put in place, particularly on internal sewer flooding. And I think the other one, and it's actually come out quite consistently for the sector, is around CMEX. and the methodology that's being proposed for CMEX well, and that's something that's been represented on by most companies. So those are the sort of three that I would specifically point to. But if there's nothing on the telly tonight and you fancy a good read, I can highly recommend it.
I'll take that. Thank you.
Thanks, Ahmed. Bartek, I see your hand is up. This is excellent.
It is indeed. Thank you very much. Can you hear me well? Sorry for the lack of video.
You can, far away.
Two things, if you don't mind. First thing, again, I will need to come back to the allowed WACC, which was discussed at the beginning of the Q&A session. You discussed the cost of debt, but you didn't say anything about the cost of equity, and the big difference I see between the draft determination and your proposal is especially on the risk-free rate, recalculation on the way how you are calculating that. Maybe you can elaborate a little bit. I mean, I can, for instance, point to the fact that the CPIH RPI wedge has significantly decreased at the DD, and whether this is your comment as well to Ofwat, but they have changed simply the way how we are calculating the wedge and consequently impacting the risk-free rate. And second thing, if we look at the draft determination, let's say OPEX side of the TOTEX allowances, do you think they are right now, or they will right now very well mimic your actual OPEX? So consequently, the bottom line here is, are the consensus estimates for a significant increase in EPS and operating profit in 2026 fully justified? Because I guess everyone of us is assuming the allowed revenues will start reflecting the proper level of your costs, given whatever the power prices increase we have seen, the chemical prices increase we have seen. Do you think the allowed OPEX side of the TOTEX indeed reflects your current costs? So consequently, we will see an increase in earnings in 26 versus 25, driven by that. So like a rebase of the allowed. Thank you.
Great. Okay, thanks, Bartek. Phil, do you want to pick those up?
Hi, Bartek. So yeah, when we talked about the WACC before, James was focusing in on the cost of debt specifically, which is why we talked about that. In terms of the cost of equity, I guess sort of there is quite a big step up between our cost of equity and where Ofwat are at the DD. So Ofwat have got a 4.8%, we're at 5.65%. I think just sort of looking at that from a top-down perspective, just to put a bit of context around that, you know, clearly we saw Ofgem at 5.2 or 5%, depending on how you cut the gearing numbers. And it's really interesting to see that, you know, Moody's rate the predictability and certainty of the cash flows coming out of the energy space at AAA. Back at PR19, they downgraded the sector to AA. And effectively their note from earlier this summer was talking about that being potentially downgraded again to single A in terms of predictability. So I think when you sort of push all that through and you look at where Ofgem is, you know, that's a very high level triangulation of our cost of equity position. The representation's got a lot of detail in it. Clearly inflation is part of that, but also sort of beta and other factors that all play into that. So I'll leave you to get into the detail of that in the detailed representation. On the second question on the OPEX side and TOTEX allowances, as we talked before, we were saying that you know, Ofwat assessed our costs as efficient in terms of our base operating costs, so we were allowed what we asked for. Clearly, the organisation is working to that allowance in terms of how we're looking to run our operation. And I think we were one of the few companies to be in that space. So, you know, we've not got a challenge in terms of trimming our base cost to get to within the allowance that Ofwat have now set. In terms of what that means for EPS, it's probably a bit more complicated because clearly there's, you know, the approach that Ofwat take to revenue profiling and how that all feeds through in terms of the numbers in AMP is probably there's quite a lot of detail to work through there. So probably too early to really guide on that at this point.
Thank you.
Okay, thank you very much, Bartek. Now, Richard Lynn, impeccable timing. Thank you very much for raising your hand. Please go ahead.
Hi, can you hear me?
We can.
Loud and clear.
Yeah, just following up from AJ's question earlier on, and I appreciate you can't comment on this in detail in terms of where you might end up in January after the final determination. But back when you published the business plan in October, you talked about at that point in the plan in the round that you didn't envisage having to issue equity. At this point, if you see the higher returns, sorry, excuse me, I'm sitting on the trading floor today, I'm not in the office. If you can hear that noise in the background, if you see the higher return, can you envisage that you wouldn't need to see equity issuance in 2025 if you get closer to that cost of equity you've been talking about today in the round of the plan?
Thanks, Richard. Look, I suppose I'll sort of go back and just sort of reiterate, and then I'll ask Phil to add to it. Look, you know, we are starting from a position of strength. We've got a strong balance sheet that gives us the flexibility. The plan that we've put back in is slightly lower than the plan that we previously had. And therefore we think that we've got the headroom as things stand. We expect there to be further movement in the round, both in terms of the sort of returns and the ODI package more broadly. But you know, it's a slightly lower TOTEX that we've put back in, and it's a higher WACC, if you like, than what we saw previously. And that funding decision is ultimately going to be determined by the sort of overall TOTEX package that comes back out, the risk and the return under the FD. But probably the best way to think about it is that the plan that we've just put back in is lower TOTEX and with a higher WACC than we've seen previously, but obviously we need to see what happens overall and what those risks and returns look like when we see the final FD. Phil?
I don't think much more to add to that. I think you've probably covered it there, really.
Thank you.
Thanks, Richard.
Terrific. Thank you very much. I don't think we have any more questions on the line. We do have one question from Thomas at BNP, who wasn't able to make it today. And I'll summarise, because we've covered some of the parts of the questions, but there's a big difference between the draft and your response. And most of the spend in your response is driven by statutory drivers. What is the risk that you're not funded for what you need to undertake? And secondly, what is the risk that you won't be able to mobilise supply chain in time for FY26 when we move into AMP8?
Okay, thank you for that last question. So I suppose first of all, in relation to what we've seen in the DD, you know, Ofwat have funded those statutory drivers. What we've gone back and presented more evidence on is actually where we're proposing solutions that are slightly different than the solutions that they may have modelled, and we've done that. As James said earlier, and we covered in the presentation this morning, comprehensively in terms of the bottom-up builds of the costs that we have, you know, a number of case studies on the solutions that we're putting forward that actually are the lowest sort of long-term cost solution. So, you know, I think Ofwat are very clear around funding statutory obligations, and they will always start from that point. So this is more around the type of solutions that we are proposing to deploy and the representation that we've made on the back of that. In relation to concerns about mobilising the supply chain, they're not concerns I have. We've already mobilised the supply chain. They're already here. They're contracted. They're already working with us. So I'm not concerned about that at all. You know, we have a significant programme to deliver here, and we've already started work. So I haven't got those concerns. You know, we've got a lot to do, and we've already started.
Terrific. So I think that is a wrap. Thank you very much, everyone, for joining. Of course, always, the IR team is here at your disposal, so please use us if you need us. And Lou, I will hand back to you.
Yeah, thanks, Chris. Thank you ever so much for everybody on the call. Thank you for you know, attending this afternoon. Hopefully you found that useful. As Chris says, the team continues to be available, and we're happy to engage and answer any questions as we go through. And we look forward to updating you with both our half-year results in November and then the outcome of our final determination towards the end of the year. So thank you so much for joining this afternoon and for all your questions. Thanks again.